gold and silver and all the rest of it. I think I can understand people needing liquidity because their budgets are probably being squeezed in this current situation. But my advice is always the same: get the hell out of credit. And if you're getting out of credit, where do you go? Well, there's only one place to go, and that is real money, which is gold. To a lesser extent, silver. I don't think silver will ever really come back as... Well, I mean, the answer is that it's been suppressed for so long. I mean, we've had a shortage of supply for the last 6 years or so. Meanwhile, industrial demand has continued to grow and grow and grow. I mean, the shortfall over the last 6 years works out at just a little less than one. I think it's sort of, I can't remember the figure, but I mean, it's enormous. I think we're looking at 1,200 million ounces. I mean, it is enormous. So I think the first question you have to ask yourself is, how have they managed to suppress the price of silver? And to me, the answer is actually quite simple, and that is that China has been managing the price. But things have changed. And the big change, I think, was at the time when President Trump was elected back in November last year into April, when, do you remember, he held up those boards with all the new tariff rates and all the rest of it. China, I think from memory, is something like 50%, whatever. I think that ahead of that, the Chinese could see that the price of silver, demand for silver was running away, and they couldn't really control it anymore. And not only that, but with President Trump threatening sort of huge rate tariffs and really being very unpredictable in the whole thing. I mean, he would say one thing one day and another thing the next day. It really meant that China had to take a different view on its exports of things like silver, tungsten, and also antimony. I mean, they have great use for this in their own industries. I mean, the photovoltaic cell business has just taken off as the West has sort of embraced the idea that, you've got to do away with fossil fuels. Also electronic use. I mean, if you look at the technology that China now deploys, I mean, it's consumer-based technology mainly, unlike the Americans, which tend to be defense-based technology. They are way ahead of us now. I mean, it's just quite remarkable. I mean, they can literally flood our markets with electrical vehicles, EVs. I mean, and all this, of course, leads to growing demand for silver. So I think the point is that they have decided that they need to protect their own silver stocks, which they will have accumulated a lot. I mean, it's bear in mind that the management of the nation's silver resources is in the hands of the People's Bank, along with gold, because they regard it as precious metal. They regard it as money, if you like. China most recently was on a silver standard. I mean, I'm going back into the 60s. So silver very much is money as far as the Chinese authorities and the people are concerned, as well as gold, of course. And so they need to, they will have accumulated substantial stocks because, apart from anything else, not only have they become the world's second largest nation by mine output, but also they've been importing doré from elsewhere and also refining other ores, like sort of copper and nickel and so on and so forth, all of which contain some content of silver. So they will have accumulated a hell of a lot of silver, but they need to protect those stocks now rather than use them to suppress the prices in the interests of their manufacturing industries. And this is the trouble. And it's happened at a time when India is growing. It's growing like China was 20 years ago. The rate of economic development in India is staggering. It really is. I mean, they talk about GDP going up 8%, whatever, but I think that's only part of the story. The point about silver and India is that there is now huge industrial demand in India because the government itself has subsidized and encouraged large businesses to get into the photovoltaic cell production industry. So they've become huge importers of silver. So, and what China is doing, the next phase, if you like, of it trying to protect its silver stocks will be in January, coming January, when they're talking about having a tighter licensing system for exporters. Basically, what this means is that supplies coming out of China are going to be more and more restricted.
Yeah.
It won't stop totally, but they'll be more and more restricted. And yet Indian demand is accelerating. And at the same time, of course, all of us who have been sitting on silver saying, oh, it's far too cheap for years and years and years, suddenly see the price rising. Do we turn sellers? No, we say we've got to hold on to it.
Yeah.
And so you can see that there's a sort of perfect storm, really, as far as silver is concerned.
The global silver landscape began changing when economic tensions intensified between the U.S. and China. Tariff threats and geopolitical unpredictability forced Beijing to reassess its export strategy. China, heavily dependent on silver for its booming tech, electronics, and solar industries, started prioritizing domestic supply over keeping global prices low. With China refining large volumes of metal and holding some of the world's most significant silver reserves, the nation has gradually tightened export controls. New licensing rules beginning this year mark a turning point. China is signaling that protecting internal resources now outweighs supporting low-cost international supply chains.
I mean, the ETFs have grown. I'm not from a large base, but I mean they've grown very, very substantially, which indicates, if you like, the sentiment there. The other thing is that you would think with these high prices that a lot of jewelry and other bits of silver would be shaken out into scrap. But that's not happening. The people are holding on to it. They're holding on to their scrap, as it were, rather than, sort of profiting from it. Because, I mean, from their point of view, do you want scrap silver or do you want rupees? Well, there's no contest.
Yeah.
So I think, it really is. It's a perfect storm as far as silver is concerned. And the problem is, in markets, in Western capital markets, is that for the last 54 years, the authorities, and particularly the Americans, have encouraged the growth of derivatives. And it is derivatives which have soaked up demand for, which would otherwise go into physical silver, physical gold, for the last 54 years. I mean, there's no doubt about it that this was the mechanism by which the authorities tried to sort of dampen down not just gold and silver, but also other commodities like copper and so on and so forth, by diverting any investment demand as opposed to commercial demand into derivatives. That's coming to an end. That's no longer happening. And the fascinating thing is that as we see the silver price and also the gold price, incidentally, rising, open interest on COMEX is declining, which tells us that this is just a squeeze on the system. And it's, I mean, the extent of this is very hard to quantify, but when you bear in mind that this distortion, by diverting investment interest into paper and away from the physical, that's a 54-year distortion, if you like, of markets. And that's now beginning to unwind. And 54 years of distortion means there's a lot of unwinding to do. And we've had moments in London, I think it was back on October the 10th or something, when trading on the LBMA was effectively suspended for an hour and a half. And then only was it last week, it was really on the end of the December contract, so it was, I think, the previous Friday, a week ago on Friday, that suddenly out of the blue, we had this COMEX failure. I mean, it wasn't a COMEX failure, it was a database failure because the cooling fan stopped working or something. Well, we can't say that was a, we can't sort of act as conspiracy, with a conspiracy theory on this one. But, this sort of thing doesn't happen because you've got backup systems which automatically kick in when a cooling system fails. And I was reading somewhere that someone who, was an electrical engineer who deals in these things and all the rest of it reckoned that, important databases like that are not protected not only by one backup system, but two backup systems. So how did all three fail at exactly the same time? Big question.
Seems a bit suspicious.
Yeah, but the point is that these markets are already facing huge strain as those distortions which are built up over the last 54 years are beginning to be unwound.
Yeah, but
this is just the start. So where does silver go? I mean, the problem with photovoltaic cells and electric vehicles and all the rest of it is that demand is unlikely to change much on a big price hike. Because this is all driven by government diktat. We must get rid of the carbon footprint, all this sort of stuff. And that's not going to change very quickly. It really is not. And I don't know how. I mean, you can get a squeeze in these markets, which would just take prices to unrealistic levels. I don't know whether that'll happen. But I tell you one thing. This is turning into, what we would call a Giffen good. In other words, the normal laws of the relationship between supply, demand, and price are just completely suspended.
While China preserves its stockpiles, India has rapidly become one of the world's most aggressive silver consumers, particularly within solar manufacturing. Government subsidies have accelerated domestic production of photovoltaic cells, transforming India into a powerful industrial buyer almost overnight. At the same time, investors, bullion holders, and even households that traditionally sold scrap metal into the market are now refusing to part with their silver. The result is a rare convergence: declining exports, rising industrial needs, and tightening investor supply. This combination has created what many analysts describe as a perfect storm poised to shock the global market.
I mean, this isn't, this is not a discussion about fair prices, fair value. Because, that's something that the market decides. And if you've screwed the market and the market kicks back, then, all bets are off. I mean, it really is. I think it also, Paul, in the broader context, what we are seeing are things happening at the end of the fiat currency system. The fiat currency system is coming to an end. And that has enormous implications for everything. If you look at bond yields in Germany, not too far away from you, are rising into new high ground. And you look at Japan, the 10-year is nearly yielding 2% now, which is just absolutely unbelievable. The point about both the euro and more particularly the yen is that these are the basis of the carry trade on which US Treasury financing has been increasingly depending. Now, if you've got rising yields in Japan in particular, the first thing that happens is that one of the largest groups of holders of US Treasuries, Japanese institutions, will no longer be buying US Treasuries because they're getting almost the same sort of yield out of their own markets without the currency risk. And on top of that, of course, the carry trade has problems. There's a huge, great carry trade has come out of the Cayman Islands, which basically is offshore hedge funds and insurance companies, offshore insurance, captive insurance companies. They've been funding their US Treasury yield pickup out of Japan in particular. And then if you look at Luxembourg, American entities have been setting up special purpose vehicles to offer higher returns to EU residents than they get out of their own bond markets. And where does that go? That goes into the US Treasury. T-bills and things like that. That is now going to get constrained. So what happens to the yields? They rise.
Yeah.
And when they rise, what happens to the equity bubble? Pop. And then suddenly you've got a real crisis.
For half a century, Western financial systems funneled precious metal investment into derivatives instead of physical bullion. Futures markets soaked up demand that would otherwise have strained real-world inventories. But that era is ending. As silver and gold prices climb, exchange activity is thinning, liquidity is tightening, and unusual market interruptions have raised eyebrows. Meanwhile, enormous structural distortions accumulated over decades are beginning to unwind, stressing the system. As paper claims detach from physical availability, markets may be forced to reconcile years of suppressed pricing with the actual scarcity beneath, potentially triggering violent upward adjustments.
I think at this stage, I would say that not that they'll turn sellers, but I think probably what they would do is they would stop investing in US treasuries. In other words, the flows into US treasuries will not meet the extra issuance of them. So under those circumstances, I think it's going to be one of the factors that drives up yields at the long end of the yield curve and continue to do so. And of course, the US Treasury is having to rely increasingly on funding, short-term funding through T-bills. It's been tapping money market funds, for example, almost acting in parallel with the Fed as, if you like, a sort of secondary central bank. This is a very unusual situation. Now, not only that, but you can see that because the US Treasury has been hoovering up liquidity, and at the same time the Fed was doing quantitative tightening, it's now had to stop doing QT, and it's going to resume QE in order to ensure there's sufficient liquidity within the financial system to stop it falling over. So, we can see the drivers of inflation beginning to really get going again in America, one way and another. And this is something which I don't think anyone's talking about. But you can see that if we get inflation coming back, when the Fed is trying to reduce interest rates and a bubble is popping, when that bubble pops, they're going to have to basically print in order to save the banking system, save also all the zombie corporations, try and stop unemployment rising, et cetera, et cetera. So, you can see the acceleration of the increase of base money, if you like, and it's going to be very serious. It's actually very similar to where the Reichsmark, the Reichsbank, was in the second half of 1921. I've been looking at these figures really because, it's when you get the end of a fiat currency system, that is the best example, the best documented example we have of what actually happens. And it's interesting because we had a roaring stock market in Germany between January, February 1920 into the tail end of 1921, when stock prices on average increased by 300%. The currency stabilized, incidentally, and was briefly the best performing currency of the lot. This was the Reichsmark. This was after losing about 90% of its purchasing power, from 1913. So you had that sort of pause. But in the second half of 1921, the gold price started rising, measured in Reichsmarks. We use the dollar as proxy for that because, the dollar was on 20.67 and it was firmly there the whole way through this episode. So as far as, the sort of, if you like, the commonality of what happened then compared with now, we got the tail end of this stock bubble. That goes pop. In the case of Germany in 1921, December the 1st marked the crash, if you like. But the crash was softened. It only fell 25% on estimates. But if you looked at the value of stocks in gold, They lost 93%. That was the difference. Because at that stage, the purchasing power of the Reichsmark was really beginning to collapse. I think we're facing a very similar situation. I mean, it's, as they say, history rhymes. And I think that's what's really what we're seeing in the next few months.
Global monetary systems are facing pressures reminiscent of late-stage historical currency breakdowns. Rising bond yields in Japan and Europe threaten the vast carry trades that helped finance U.S. debt for decades. If foreign buyers retreat, U.S. Treasury markets could face severe strain. At the same time, elevated inflation and renewed liquidity injections are eroding confidence in fiat currencies. When faith in credit weakens, monetary systems can unravel quickly, sometimes dramatically. Historical parallels, including Europe's early 20th century currency failures, highlight how fragile the end stages can be and how rapidly asset prices can detach from collapsing monetary units.
I think a point which very, very few macroeconomists actually understand is that it's not just a question of the expansion of the quantity of credit in the economy that undermines its value. It's also the faith that the users have in that credit. Now, I don't see the average American getting terribly worried about that. I mean, he'll see his, price of gas, as they call it, petrol going up. He'll see price of food going up and all the rest of it. He's already seeing that, actually. He'll see that accelerating. And he'll blame it on, greedy capitalists, whatever, not money supply. But when it comes to the faith, that is a far bigger factor. And bear in mind that foreigners, according to the US Treasury tick figures, they have a total of over 44 trillion of dollars and underlying dollar financial investments. 44 trillion. Bear in mind that US GDP is in the order of about 30 trillion. This is just absolutely enormous. The amount in equities is 20 trillion, over 20 trillion in fact. So when that bubble pops, what do foreigners do? They do what they've always done in the past. They try and get the hell out. No, they won't realize 20 trillion, that's for sure. They'll probably end up getting out something like 9 trillion. But you can see that there's going to be massive selling of the dollar in the foreign exchanges under those circumstances. And it's all part of the unwinding, if you like, of carry trades and all the rest of it. All this sort of stuff is coming to a head. And the result is that the purchasing power of the dollar will go down far further than anyone today, even a bear in the market, would think is likely. This is the important point. We are living, I mean, when you get a collapse of effectively of a 54-year-old system, it's dramatic. It really is dramatic. And, this is sort of partly my mission, if you like, current mission, to try and sort of get people to understand this. I doubt we'll get the political class to understand it because their terms of reference for what their electorate wants. Their electorate is just totally ignorant of these facts. And they're all chasing, we want the government to give us more money. They're all in that mode. And that's not going to change. That is not going to change at all. So politicians just ignore all this at all. I can tell you, underneath it, we are living in extremely dangerous times. And the ending of the fiat currency system, it basically threatens to wipe out the value, all the value of these paper currencies, unless a government gets itself into the sort of position where it can actually deal with it, balance its budgets, produce a surplus on its budget, so get the country out of the debt trap, which is rapidly coming upon them now, and adjust economic policies so that they can actually sustain a relationship between their paper currency and gold. Otherwise, there's no knowing where this stops. I mean, in the case of the Reichsmark, in 1913, there were 90 Reichsmarks to an ounce of gold. At the end of it, there were nearly 100 trillion to an ounce of gold. Yeah. That's what happens when you when a fiat currency system ends. Take profits in gold and silver and all the rest of it. I think I can understand people needing liquidity because their budgets are probably being squeezed in this current situation. But my advice is always the same: get the hell out of credit. And if you're getting out of credit, where do you go? Well, there's only one place to go, and that is real money, which is gold. To a lesser extent, silver. I don't think silver will ever really come back as official money, if you like. But there is no doubt about it that there is a very large portion of the global population that still regards it as money. And at the moment, that price is being driven entirely by this squeeze from industrial demand, while at the same time, China is reducing her supplies into the West, which means it could go considerably higher on those grounds alone, without even any debate about its monetary qualities.
As the current financial cycle reaches a critical turning point, investors are increasingly reevaluating traditional stores of value. Gold remains the primary refuge when credit systems falter, but silver, driven by both industrial necessity and renewed monetary interest, is gaining attention. With tight physical supply, rising demand, and constraints on exports from major producers, silver's price could climb far more dramatically than most expect. In a world where currencies face growing doubts and governments continue to expand debt, tangible assets with intrinsic value become essential. For many, shifting from credit-based wealth to real metal is no longer optional. It's protection.